Racing for a big rally in the next few weeks, could be led by tech. Let's bring in Fundstrat's Mark Newton. It's good to see you again. I got two numbers on my mind, all right? 4,200 S&P. Got closer there today before backing off. I just looked at the VIX. I mean, we might go 15 while we're having this conversation. What do we make of both?
The VIX should be heading lower. There's nothing that has really spooked the market in the last month since it peaked in mid-March. So the VIX is down about 50%. Stocks have slowly grinded higher. Those are conditions where the VIX typically falls.
Lower than
I actually see an upcoming bottom in the VIX likely this week. It could start right near the Fed meeting. Even though I still expect the market to be higher this month, at least into mid-month, the VIX very well might bottom and then make a secondary low. For reasons such as, look,
why does the VIX go lower into the Fed meeting?
It's on a severe downward spiral right now, and the VIX has been going down for a month and a half. It's dropped sharply. There's no reason to try to time the bottom unless you look at things like spot VIX compared to back month, and there's a huge contango right now. You look at the VIX is at under 16, and August VIX, I believe, is at 22. So there are a few things I look at that suggest we're close to a bottom and imply volatility. That doesn't mean the market has to sell off violently, but I think you probably will get some sort of a reaction near the Fed. The real key is going to be technology. Look, I think the risks are rising in May. I call it, the three S's. The first is, of course, seasonality. We have exited sort of the golden period of pre-election seasonality, which starts in October, ends in April. We're out of that period officially. Sentiment has recognized this rally over the last 4 out of 5 weeks. I mean, we've seen things like fear and greed, investors' intelligence have all risen. We saw levels near 25 in March. Now they're up near 65. That is worth paying attention to. Sector rotation, probably the most important. So we've seen a huge uptick in defensive trading in the last month. If you look at an equal-weighted basis, the top 5 sectors are real estate, discretionary, utilities, staples, and healthcare. So those are all extremely defensive. Technology, if on an equal-weighted basis, actually is down over the last month.
But you think technology is vulnerable if we're going to have some May choppiness?
I think tech is close to stalling out, and that should happen this month, and we should actually retreat in technology. And now, I'm not saying sell tech and go away. I'm thinking that tech has had a big run. You've seen equal-weighted tech break down versus the equal-weighted S&P thanks to semiconductor weakness, software. It's really been FANG that's really helped to disguise technology, and that's going to be something to pay attention to.
So you think we can get to 4,300, 4,325, right, but that technology is not going to be the thing to take us there?
Near term, it's likely going to be 4,200 where we hit a wall this week and we pull back. Short term, very maybe 1 or 2%, and then we likely move up above 4,200. That causes the final stage of capitulation where everybody's eyeing that as being an important level. They have to cover shorts, breakout buyers emerge. I don't think we get above last August peaks at 43.25. So for me, there's 2 to 3% upside, whereas the risks of a pullback, given the defensive trading, seasonal concerns, uptick in sentiment, those are important. But you don't have any traditional sell signal right now. I mean, in terms of trend following, things are still very much intact with regards to the market.
I'm wondering, and some have raised the issue of whether the Fed decision, if it's a pause, is a sell the news event. How do you see that?
I think after a 500 basis points in hikes over the last year, I think 25, whether they do 25 or not, is irrelevant. Only, except for this one major thing. In the March Fed minutes, they came out and said there's going to be heightened risk of a recession later this year. So why in the world would they continue hiking if even the Fed itself says there's going to be a recession later on?
Well,
so
let's just say it's
I think the market is out of touch with what the Fed is saying right now, and those two things have to really reconnect. I mean, I don't necessarily think there's going to be a drop in rates. I don't think they're going to have to cut later this year, but I think we could easily have a meandering period where we go nowhere, where the Fed is done, and we have to wait and see. I think, personally, that's a smart move.
What's the best part of the market right now?
Well, I love healthcare. I think that's coming into a very seasonally bullish time. We've seen short-term breakouts in medical devices and some parts of biotech. Pharmaceuticals are a great defensive area to be. So tech is starting to wane a little bit, and if anything, you're still seeing good strength in discretionary. Casinos, home builders, those have been very, very good areas.
MGM coming after the in overtime
look,
tonight.
You have to respect the seasonal. You have to respect the defensive sectors as well.
What about energy? What about energy?
Energy
I know it's been a
still
disappointment.
Seasonally in a good time, but it certainly has disappointed. I'm waiting for crude to stabilize a little bit and go higher. I'm a longer-term energy bull, but it certainly has stalled out a little bit. You have to be a little bit more selective until crude really starts to get back up above probably the low to mid 80s.
But I mean, that's been a debate whether you need crude prices to really go up for energy stocks to work, and some make the case that you don't. I mean, it's a 75.
I wouldn't disagree
76.
with that. Look, you saw a period where energy held up fine, even though crude was declining. And then finally, the mean reversion kicked in for energy. And now, if anything, things like XLE are still okay by my book. So I don't mind energy, but I really want to be in healthcare. I like industrials. There are lots of parts of industrials that are really in good shape. So you have to be diversified. And if anything, the correlation indexes have dropped substantially, that you can be a stock picker again. You know, the CBOE 3-month correlation is down to a 30%. Stock picking is working in this environment. You don't need to own broader technology anymore. You can diversify your assets, and I think it's a golden time for stock picking.
Yeah, but you have to believe, as you do, that you're not going to have a recession. You can't tell people to buy cyclical stocks if you think that we're going to have a recession, which you just said you don't. You don't think we're going to. You said, I don't think the Fed's going to need to cut, implying that you don't think we're going to have a recession. I know Tom Lee doesn't think so.
The great Jesse Livermore once said, the market is not wrong, opinions are wrong. The market, since last October, has shown its very good performance, and until I see that changing, I think, in general, the market's going to respect inflation starting to fall off a little more quicker than an earnings recession or the threat of a recession where everybody in the world thinks we're having a recession. I think it's going to be postponed. I don't see it necessarily needing to happen this year.
Okay, we'll leave it there. Appreciate it. Mark Newton, thank you very much. All right, up next, we're tracking the biggest move.